They told you it was a barbarous relic. They told you it was just an industrial byproduct. For decades, the mainstream media, the big banks, and the Federal Reserve have worked tirelessly to convince you that silver was irrelevant, a distraction from the stock market rally. They told you it was impossible for it to break past $30, $50, or $70. Well, today is Saturday, December 27th, 2025, and as you watch this, the global financial system is experiencing a seismic reconfiguration that no one in power wants you to understand. The kill switch has failed. What we have witnessed in the last 48 hours is not just a price move, it is a violent and disordered phenomenon of price discovery. So we are watching the total death of the paper market and the absolute triumph of physical reality. As we sit here right now, the silver spot price has shattered the technical and psychological barrier of $79, ending the trading session at approximately $79.24 US dollars. This isn't just a rally, it's a massacre of the short sellers. While the West was sleeping off a holiday weekend, the East was setting the stage for a total delivery default. In Shanghai, silver isn't just expensive, it is disappearing. We are witnessing a divergence between physical Asian markets and Western paper derivatives that has no precedent in modern history. The banks that held massive short positions at $70 and $75 are being systematically liquidated. The arbitrage that usually keeps global prices in a tight range is broken. And with the U.S. Navy currently enforcing a total military blockade in the Caribbean, the era of cheap, abundant silver is not just over. It has been buried. If you want to stay ahead of this collapse and understand the hidden forces moving your money, make sure to subscribe to Markets in Context right now and hit that notification bell. I'm Kevin Huang, and we are tracking every move of this global squeeze as it happens. If you have physical silver in your hands, hold it with a death grip. If you don't, you are looking at what might be the last 72 hours of accessible pricing before we enter the three-digit era. Let's look at the hard numbers because the math does not lie. Between the close of Friday, December 26th, and today, Saturday, December 27th, 2025, we saw an implacable buying pressure that simply refused to let up. Silver opened today at $77.32 and accelerated with terrifying speed toward an intraday high of $79.38. Why is this significant? Because on December 26th, silver gained over 7.4% in a single session. It didn't just tap the $75 resistance, it blew through it, then vaporized the $76 resistance, and now it is staring down the $80 psychological wall. Look at the volatility table from the last 3 days of trading. December 25th saw a 1.6% gain. December 26th hit a massive 8.25%, a vertical parabolic move that signaled the total capitulation of the shorts. Today, December 27th, we are consolidating near the absolute highs with another 2.5% increase. This is the definition of a short squeeze. For years, institutional players have been opening massive short positions, betting that the price would never stay above $70. On December 26th, the market moved $7 in a single day. That isn't normal trading. That is the sound of thousands of short sellers being forced to buy back silver at any price to keep from going bankrupt. Their desperation is the fuel for our rocket ship. For my viewers in Europe, the situation is even more extreme. The silver cross in euro is currently trading at 63.57 euros per ounce. In the last year alone, the purchasing power of silver against the euro has increased by a staggering 125.81%. This isn't just a commodity play anymore, it's a strong buy signal acting as a shield against the total erosion of fiat currency. But even more shocking than the silver price is the gold to silver ratio. While gold has hit a record $4,557 per ounce, an increase of nearly 78% year to date, silver has more than doubled that performance, with gains up to 169%. The ratio has collapsed from 104 in April down to the 57 to 58 range today. Historically, when this ratio collapses during an explosive bull market, it doesn't stop until it hits the 30 to 1 or even the 15 to 1 geological mean. If gold stays at $4,500 and the ratio returns to its historical mean of 15 to 1, the silver price would be $300 an ounce. We are at $79. Let that sink in. To understand why the kill switch failed, you have to stop looking at London and start looking at Shanghai. China is currently the epicenter of a physical supply crisis that is distorting the entire global price mechanism. One of the most dramatic and counterintuitive events of the last 48 hours was the vertical collapse of the UBS SDIC Silver Futures Fund in China. While the global price of silver was exploding, this fund crashed 10%, the daily limit, for multiple sessions. Why would a silver fund crash while silver is hitting record highs? Because the demand from Chinese citizens was so desperate that they bid the fund up to a 62% premium over its actual silver holdings. People were so scared of their own currency and the collapsing real estate market that they were willing to pay $162 for every $100 worth of silver. The managers had to step in and limit new subscriptions to just 100 yuan, about $14, to stop the frenzy. This crash was caused by too much demand, not too little. It is a symptom of a market where capital is frantically seeking an exit from fiat and finding silver as the only life raft. It's not just paper panic in China, it's physical reality. We are seeing a state of backwardation on the Shanghai Gold Exchange. In a healthy market, silver for delivery next month is more expensive than silver today because of storage costs. But in China right now, silver for immediate delivery costs more than future silver. This signals an acute, immediate shortage of material. The Shanghai silver benchmark jumped from 15,118 renminbi per kilogram on December 19th to 18,471 renminbi per kilogram on December 26th. This creates a massive arbitrage opportunity. Traders are buying every single ounce they can find in the West at lower prices and shipping it to Shanghai to pocket the difference, effectively draining the vaults of London and New York. Silver inventories in Shanghai have hit levels not seen since 2015, just 531,211 kilograms. This is a 10-year low at the exact moment industrial demand for solar panels is consuming 25% of the total annual supply. The tightness of the physical market is confirmed by the behavior of the silver futures. The spot contract closed at 19,400 yuan per kilogram, maintaining a structural premium that makes it impossible for market makers to close their short positions without incurring massive catastrophic losses. But the price jump on December 26th and 27th wasn't just about supply. It was about a massive risk premium being added due to sudden military escalation. First, look at the Caribbean. President Trump has announced a total and complete blockade, not a quarantine, of Venezuelan oil tankers. This represents a dramatic escalation of U.S. foreign policy. The blockade follows the U.S. seizure of the Venezuelan supertanker Skipper on December 10th. The White House has ordered the Navy to focus almost exclusively on this blockade. Shirano missile destroyers and amphibious assault groups in the Caribbean waters. Russia and China have already signaled support for the Maduro regime, and Beijing has warned that their own ships could be involved, raising the risk of direct conflict between superpowers. Why does a blockade in the Caribbean move silver? Two reasons. First, the risk of conflict pushes investors toward tangible, safe haven assets that are independent of the fiat system. Second, the blockade of Venezuelan oil creates an immediate supply shock in the energy market, fueling expectations of inflation that historically favor precious metals. At the same time, the U.S. conducted powerful and lethal air raids in Nigeria against Islamic State and Lakurawa forces between December 25th and 26th. President Trump justified this as a mission to protect Christians from persecution, signaling a return to direct U.S. military interventionism in Africa. This global instability makes silver the ultimate apolitical global asset. The market is perceiving that risk is now everywhere, not just in Ukraine or the Middle East, and that is increasing the attractiveness of the only asset that has no counterparty risk. While demand is exploding, the side of supply is showing terrifying structural rigidity. Even with a historic 18-year strike at the Cananea mine in Mexico finally ending, the impact on immediate supply is negligible. Cananea is primarily a copper mine that hasn't operated in 2 decades. Rebuilding its infrastructure will take years and billions in capital. The market didn't see this as a bearish sign of new supply. It saw it as a reminder of how difficult it is to operate in jurisdictions like Mexico. The world's largest primary silver producer, Fresnillo plc, is seeing its stock fly in London. But even they are selling off concessions to junior miners like Vizsla Silver to focus on existing efficiency. Fresnillo maintains an all-in sustaining cost of about $17 an ounce. With silver at $79, their margins are unprecedented. Yet they aren't finding enough new silver to meet the world's needs. Pan American Silver just released a year-end update confirming that replacing the reserves they extract is becoming costly and technically complex. We are heading into 2026 with a 5-year structural deficit. Global production fell by 1% and shows no signs of recovery. You cannot print silver like you print dollars or euros. It takes an average of 10 years to bring a new mine from discovery to production. Meanwhile, the solar industry is devouring over 20 to 25% of the annual silver supply. If industrial demand stays inelastic, meaning they have to buy it at any price to keep their factories running, the gap between what we dig up and what we need is going to become an abyss. The kill switch failed because physical reality has finally overwhelmed manipulation. The world's most prestigious investment banks have been forced to tear up their old models. Goldman Sachs has labeled silver the indispensable strategic metal for artificial intelligence and the green transition, targeting a range of $85 to $100 per ounce for 2026. They argue the deficit is structural and insensible to price, meaning manufacturers of artificial intelligence chips and solar panels must buy silver at any cost. Citi is calling silver the fast horse of the sector, with targets up to $72, fueled by a juggernaut of retail demand. Robert Kiyosaki and other independent analysts are even looking at a range of $100 to $200 as the gold to silver ratio returns to its historical mean. Yes, there will be volatility. Today's relative strength index is over 80, meaning the market is deeply overbought. We could see a washout or a temporary price drop as institutional players try to shake the weak hands out of their positions. But do not be fooled. Any dip toward $70 is now being viewed by the world's biggest banks as a gift and a new floor. The old resistance level at $70 is now the new solid pavement. Today, December 27th, 2025, marks a point of no return. If you're waiting for a return to cheap, abundant silver, you're going to be left behind in the old era. We have entered the era of strategic scarcity. Silver is disengaging from the traditional trading models. It is no longer just gold with leverage. It is a scarce industrial asset with sovereign monetary properties. The situation in Shanghai is critical. If inventories continue to fall, we could see a technical delivery default or a drastic government intervention to block exports and nationalize supplies. This would cause global prices to explode overnight. The $100 target is no longer a fantasy. It is a concrete possibility modeled by the most prestigious firms in the world. Watch the $80 level closely over the next 72 hours. If we break and hold above it, there's no technical resistance left until we hit $100. The system is breaking and the metal is winning. If you found this breakdown valuable, don't forget to like the video and share it with someone who needs to see this data. I'm Kevin Huang, and this is Markets in Context. Subscribe now to stay in the loop, and I'll see you in the next one as we watch the Open in Shanghai. Hold your physical, protect your wealth, and prepare yourself for the first week of 2026. We are in uncharted territory. Make sure you are subscribed for our next update where we will track the Monday morning open in Shanghai. If the China syndrome intensifies, $79 will look like a bargain by Friday.